You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it is time once again for the Advisor's Option, the program here on the Options Insider Radio Network for you, the busy financial advisor or asset manager. Maybe you're wondering how you should really go about using these options things in your clients' portfolios. Maybe you're thinking about getting yourself a financial advisor. You want to know what skills they should bring to the table. Either way, we got you covered. My name is Mark Longo from theoptionsinsider.com. So as, of course, from the ever-exciting Options Insider Radio Network. A lot more on the docket for you as we roll on into the end of the year. So however you listen live after the fact, stay tuned. You have some good stuff in store for you, including another great pro Q&A coming up a little bit later today with the Spikes father himself, Mr. Simon Ho. So get your vol questions, get your crypto questions, get everything else. A lot of you already have. Get them in for him. That starts in, I believe, 2 hours. So it should be fun. He's got to wake up. He's beaming in from Sydney. So he can't go too early for him over there. But of course, it is December. That means it is time for our 2021 Look Back Year in Review extravaganza. And who better to join me to look back on the insane year that was 2021 than our old friend, Mr. Matt Amberson, the founder and principal over there at ORATS, a.k.a. Options Research and Technology Services. Mr. Matt, welcome back to the Advisor's Options, sir.
Great to be here. Did 2021 go faster than 2020? I don't know.
I don't know. In some ways, it seems like it did. And in other ways, you look back to things like January 6th and you think that was less than a year ago. It seems like it was a lifetime ago in many other ways. It depends on your frame of reference, I suppose. Speaking of your frame of reference, let's get to that. We have a lot to digest, a lot to analyze on this show. It is time to kick things off with the P&L statement year in review edition.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everybody, welcome to the P&L statement. Again, this is a statement that was born out of the pandemic, pretty much. We found ourselves every month on the show spending a lot of time just talking about what the hell just happened. Because every month there was some other litany of insane, unprecedented events. 2021 has been no exception. But before we look beyond the immediate rearview mirror, Mr. Matt, let's start with what we've been seeing since our last show. Obviously, over the past month, all eyes were on Omicron and the Fed. We may have some answers to one and maybe some answers to the other now. What are your thoughts on, last time we gathered here together, everyone was panicking and freaking out about Omicron, Vol. What are your thoughts on that and perhaps its lingering implications towards the end of the year, sir?
Well, I think we stated on the show that Omicron is, and while it's pervasive, it's not as deadly or dangerous as the other things. And I have a pretty good feed of alternative news that helped me parse through all this stuff. So it's, it came in handy over Omicron. And we thought it wasn't going to be as bad. Certainly, many of the numbers that I look at haven't been as bad as, it seems out there in the news media, let's say. I look at the shape of the implied volatility term structure, contango backwardation. It never really got too bad. I look at this kind of forward volatility relationship. It never got too under duress. I had a client that said he was feeling the same way, but he looked at the CDS, the credit swaps, or how wide the credit market, and they're not too wide. So there's a lot of things out there that were hinting that it wasn't going to be as bad, and indeed it wasn't as bad. There were some small corrections there. But it wasn't really as bad, the Omicron, as the Delta, and certainly not the initial signs of COVID, obviously back in mid 2020, Mark.
Yes, unfortunately, we have some precedent now for dealing with waves of pandemic. This is old hat to us now. I heard someone joking recently, can we just maybe be done with the Greek alphabet? No more Greek alphabet breakthroughs in 2022 is the hope there. But yes, you're right. Initially, we had that panic with Omicron coming on Black Friday. Things are obviously exaggerated on a day like that as well. It's a half session. Markets are thin, so whatever moves you're going to get are going to be exaggerated. A over 2% sell-off if it was a regular trading day? Probably not, but you never know. It did seem like the bears had the bit in their teeth that day, and they were driving things down. And vol actually remained elevated for longer than we have traditionally seen with these little sell-offs. It lasted for the better part of a week, which is a decent amount of time for some volatility out there. So again, intriguing stuff to look at. And speaking of intriguing, Matt, we have to look back now. It is that time of year. It is where we have to look at the whole year and in the microscope and kind of pick apart some of the interesting trends and developments. And it's interesting to me, Matt, as I've been crunching the numbers here, and we're going to do this a lot throughout most of our shows this week. And I'm curious if you are of the same opinion. As I started crunching the numbers, I started thinking, this year got off to an insane level. I mean, January, I don't know how you can encapsulate January. Everyone came into this year just hoping, just praying for a bit of a pullback, not in the markets, but it's a pullback from the crazy, a pullback from the insanity. 2020 was obviously unprecedented by any measure. They were hoping 2021 would come in a little bit meeker, come in like a lamb rather than a lion. And 2021 did not get that message. They came in completely the opposite. We, of course, had all the madness of January 6th. We, of course, had the GameStop, the meme stock palooza kicked off. in January, with GameStop getting well into the hundreds, vol into 1,000. Think about that. We saw a major name trading at sustained 1,000+% volatility levels for multiple sessions. These are things that, we were taught when we first walked on at least I was, and probably Matt as well, first walked on the floor of the CBOE. These are things that really can't happen. Maybe you have a brief flirtation with it in a biotech for a few seconds, right? Maybe immediately preceding or immediately after an FDA announcement, something crazy like that. But these are not things that are sustainable. And yet we saw that this year. And so we had the VIX kicking off the year at a pretty lofty level, pretty close to 27. It closed a little bit shy of 27 on that first trading day, 26.97. And it hit its high, closing high at least for the year, in that same month, later on in January 27th, in the middle of all this meme stock frenzy, it closed at 37, about 37 and a quarter. And that was pretty much its closing high for the year. We never really threatened that level again. We got into the 30s a few times, but that was really about it. So I don't know, Matt. I'm kind of wondering, as I look back on these numbers now, was January the apex of crazy for the year? Or do you think we had other moments that matched it throughout the year?
Well, I'm just going to reflect on a good point that you made. Is with GameStop, we had to actually go in and change our rules for what is an error for implied volatility. It got so high, and then I started thinking about, Wilt Chamberlain. I think he's the greatest basketball player. Some people, you're living in Chicago, you might have a different opinion about that, but the best argument is they had to actually change the rules for Wilt Chamberlain. He was so good. And when you start changing the rules, then that is something special. So I think GameStop was something that was we're not going to see a whole lot of. And it was such a big deal that this and the other meme stocks have actually changed the way we look at volatility, changed the way we look at skew. I often talk about that 5 delta, and that is still pronounced in the marketplace. So there is, especially in the Russell component. So ORATS has a weighted average components of all of the 2,000 stocks underneath the Russell 2000. And one of the things that we average is the 5 delta implied volatility of the call 30 days out. We do a bunch of other ones too, but if you divide that by, let's just say 75 delta, so it's essentially the puts divided, or the call divided by the puts. Usually it's about 80%. The calls are never as high as the puts. Well, now in all of those components, it's been high. It was well over 1, and now it's still lingering around 1. So I think that the big thing is that of 2021 to me is the onset of the meme stock, onset of Reddit, onset of the retail traders, onset of the Robinhood effect. And you could see it in the skew, and you could see it in still some of these implied volatilities, well up above 400 in some cases. So I think that's the biggest story. But I agree with you. Yeah, January was the highest IV. It touched that, barely touched that levels in just this last kind of Dece area, but a little bit at the beginning of November. But yeah, January got up there quite a bit. But again, nothing towards the levels that we saw in 2020. Clearly, even October of 2020. I like to look at the SPY or SPX at the money volatility of 30 days. I know it's pretty similar to the VIX, but there's some other things going on in the VIX. But that peaked out at 31 in October of 2020. Jan of 2021 got up to about 26. So a little bit lower, and then it's kind of sat around there. The interesting thing to me is how vol has remained pretty elevated, even at high levels of the market. There's still a lot of concern out there. There's still a lot of worry out there. Skews actually of the SPX is pretty high still. So those are the things that are sticking out to me of 2021. Obviously, there's a lot of smaller stories, but that's what I'm thinking about, Mark.
Now, since we're touching on the meme stock here and the whole meme stock palooza We had an interesting question of the week recently. Matt, I'd be curious to get your thoughts on it. We asked our audience, we kicked off the year riding the meme stock wave, but has the interest in names like AMC, GameStop, rockets, your B-bigs, you pick your poison out there. Has that begun to cool? Quite simply, is the meme stock wave dead? We asked you guys this last week. We gave you 3 choices if you want to do, because yes and no is no fun. You got to have a curveball out there. So we gave you yes, no, and I prefer crypto. The results are in. Mr. Matt, if you want to hazard a guess as to which way our audience voted, have at it. And then more importantly, well, what are you feeling? Are you thinking the meme stock wave still has legs going into the new year, or is it starting to peter up?
Well, I do. I mean, I think that I look at the data, and the data is that the skew is still pretty elevated, and I think that you have to apportion that mostly to these meme stocks. So, whereas it's not the craziness that we saw. I mean, that was insane in January. We haven't seen that nor nearly that, but you still see the skew out there, and you still see some incredibly high volatility, and you still see people jumping on a particular stock. It's nothing like we saw before, but it's still there, definitely in the skew. And then you mentioned crypto. It was on the show when we saw BITO come out, and I've been loving BITO because I have some crypto and I'm able to. I'm too lazy to work on Ledger X, but I have my ability now to put a collar on, even though I don't have any underlying there. So I've been loving that. I did my first trade on the show, so I've been loving BITO, and and there's a lot of interest in crypto, obviously, and I have kind of an ambivalent feel towards crypto. We've talked about that in the past, but yeah, definitely crypto. But still the meme stocks are there. And I think those are the bigger things that I've seen, Mark.
Yeah, BITO's been a fun one to be trading around with. We'll get to that in a little bit later here on the show. Really quick, some other looks back. By the way, our audience, how did they vote on the meme stock poll? They were pretty split. Exactly 50% said no, the meme stock wave is not dead. 43.6% said yes, it is dead. And 6.4% said I prefer crypto. So if we didn't throw that little curveball in, it would have probably been a straight 50-50, which I guess makes a market and perhaps also shows that perhaps the mad meme stock days are not fully behind us. Speaking of behind us, we got some levels in the S&P that seem to be behind us, at least for right now. The year started, SPX 3,700. And remember, it wasn't that long ago. It was back on our big election night special from a little over a year ago where we were testing 3,300 overnight on that episode. So since then, we never really retested that 3,700 level. We got north of 4,000 right around the end of March, beginning of April. And we never really looked back to that level either throughout the rest of the year. In fact, even during the teeth of these recent sell-offs, or we had a sell-off back in early October, which maybe gets lost in the wash with all the other mini sell-offs we've had over the course of the latter part of the year. But we got down about 4,300 there. That was the closest we got to really retesting the 4,000 level. And of course, during the recent sell-off, everyone was panicking. The sky was falling. S&P was off 2%. Still, the low we got was 45.13. So interesting times. Of course, S&P pretty much hitting new all-time highs just about every day over the course of the past week. So 3,700 seems like a distant memory, at least for now, unless, of course, all these Greek alphabets start to rear their ugly heads again out there. Hopefully, we won't have repeats of those. I think everyone could use a bit of a break from that out there. But we don't need a break from the earnings madness. This past season was a good one. Let's get to the earnings volatility report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, everybody. Welcome to the Earnings Volatility Report, the portion of the show where we try to condense all of the info that Matt and his team pack into those earnings move results, earnings season, and now the newly minted, newly coined earnings trades reports. Take all that info and condense it down into one segment. Matt, we were thinking this past cycle of earnings was going to be a bit of a banger, and it seemed like it pretty much turned out that way. Give us an overview of what you saw from this past cycle and any surprises there before we get into the full madness of 2021, sir.
Yeah, so just to take a step back, at ORES, we look very carefully. And of course, Mark, you were instrumental in getting us to put these reports together. So what we do is we break down the earnings season into 6 weeks, and we look at the straddle, and we have ways to take the residual straddle amount out. So we think we have a very accurate way to predict what the market is expecting the move to be, and then we compare it to the actual move that happens. And what we say is that, if the move that actually happened is bigger than the implied move, then the owners of the straddle do well, and if it's the other way, then the sellers of the straddles do well. And we've been doing this for many years. I was just looking back, Mark, over 2019, 2020. We'd move between 100%, which is a break even for everybody, 90%, which is the sellers of the straddle make 10%. In some cases, one of the higher ones, July, sometimes would surprise and maybe get 10 or 15% above for the owners. But then right when COVID hit, we went from, for example, in January before COVID, it was 111%, meaning the buyers did well to the tune of 11%. Then in April, it was 89%. The 6 weeks following the July 2020, 78%. 72% in October. That was crazy. And then it got even crazier. Then January 2021, 74%. And we're like, what is going on? 72% in the April of 2021. And I think, July started to make a little bit of a comeback. And you said, is it ever going to get better? I go, I'm starting to feel it. And then, so finally we got at least to about a break even last earnings, which is a big move for us. October, anywhere around 100%. And I was saying, earnings lives matter. So I think earnings is going to be back. We're seeing people starting to care again about actual PEs and actual what's going on in the specific companies and what they're announcing and such. So, so that's what's going on in earnings. And like you said, the newest thing is we have we've tested a lot of the data points that we have in the earnings move report. Things like what is going into earnings, what is the implied earnings move divided by the past earnings move, or what is the X earnings. So we have ways to take out the earnings effect from the implied volatility of a stock versus what the kind of historical volatility is. Is the vol high or low, and does that matter? And we found that these are important indicators for profitable trade. So we looked at buying straddles, selling straddles, but the best strategy was the time spread. And a lot of great traders like Passarelli, and he loves the time spread. And finally, I proved it to myself there that the time spread is doing the best in our testing as well. And so we put out those trades that have similar characteristics to the most successful trades over the last 4 or 5 years. So that's what's up in the earnings season, the earnings trade, Mark.
Mr. P. Yeah, he didn't even know he's been doing shows with me forever. He didn't even know we had all this earnings data from you. And then I told him recently, he said, really? Where can I go find that? And then next thing I know, he's loving the ORATS report. So you've converted him to the dark side there, Mr. Matt.
Yeah, and he's come over and they're asking for other information. So he's really into it. I've known him for a long time. And I said, Dan, we have a lot of this data. I'm good.
Yes, he does like himself some earnings time spreads. And as you mentioned, this past cycle, maybe, dare I say it, getting us back to, some semblance of normalcy. 99%, you may say, well, big deal. You didn't even break even. But as Matt just pointed out, if you looked at all of the cycles since this madness kicked off in 2020, you saw a whole heck of a lot of nothing, which is counterintuitive to a lot of people, that in a time when overall broad volatility was high, that earnings vol was seemingly non-existent. And that was the case season after season, cycle after cycle. It didn't really matter how much vol you squeezed out of a particular name. There was always more to go. And finally, we saw this past cycle, week 1, 98%. So that was one of our first really kind of almost break-even weeks. That in and of itself was a big deal. Then week 2 was back to more of what we've expected throughout the entirety of the pandemic, which was 58%. So pretty much vol got annihilated that week. And then week 3, back to 90%. And then week 4, we saw our first dose, our first glimmer of hope of outperformance with 114%. Week 5, 99%, so still holding firm. And then week 6 coming in at 99%. So 119%, and the average, I should say, for the season was 99%. So very close to breaking through out there. So Mr. Matt, are you prepared to go out on a limb? Are you feeling for our first cycle of 2022, you think we're going to get some outperformance, sir?
I'm much more confident. Yeah, I think that the owners of volatility are going to get their comeuppance pretty soon. Interesting stuff. We shall see. As we keep on going, let's go back and look back a little bit at some of the fun learning we did on the show, a little bit of the old Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
I see you guys out there all chatting about time spreads, but don't worry, we'll get to some questions a little bit in the office hours. I also see P&L man lurking around in there. Little birdie may have told me that maybe you had some surgery today, so hopefully you're feeling better. Glad you could join us to convalesce with some of our shows. We'll try to keep you distracted as you recover out there. Let's go on out now. Look back at a year's worth of options learning here on the old program. You know, we like to do this whenever possible. For advisors, when we first were putting this show together, when I sat down with OIC and Alan, who was over there at the time, and years ago, and said, we started talking to advisors, but what would you like from a show aimed at you that was about options? And overwhelmingly, they all said, yeah, we really kind of want to learn more about these things. So that was always been a big focus, a big impetus for the show, is to kind of just educate advisors about options. And these guys, they're busy dealing with clients, and also they have professional pride. They maybe don't want to turn to the broker next to them or the advisor next to them and say, hey, what are these covered call things again? They don't want to do that, but they can listen to a show like this and go down that path of learning on their own time. And a lot of them are used to things like CE credits and others, so they're used to getting this type of education anyway. So it's always been a big focus for the show, and that continued this year. Let's look at just a few things we talked about on the show this year. We kicked off, we had a bunch of things that kicked off the year, obviously. Meme stock madness was a big discussion point. But in terms of Options 101, early on in the year, we got into, it was a popular topic earlier this year for optimal covered calls. I remember we had a few great guests like Steve Sears, formerly of Barron's, and others out there to join us to talk all about that and our optimal covered call setups and strategies. We know for a lot of asset managers and advisors out there, and for a lot of our general listeners, covered calls are still their go-to options strategy. So there are many different ways to approach them. Of course, out of the money, in the money, the duration you go for, all sorts of things like that. So that was a fun episode. Dan, you got Dan Passarelli on the brain. See what you've done to me now, Matt. Matt, do you recall our discussion on covered calls, and what stands out to you as you're thinking about your optimal covered call here at the end of the year, sir?
Well, that's one of the bigger back tests that we've done. So we looked at 3 million different trades on a bunch of different stocks. And what we found was we look at different days to expiration, different deltas, different exits, should you trade through earnings, a bunch of things like that. And so here's kind of the synopsis of it. It's about a 30-day, but more of like a 15 or 20 delta. So farther out of the money, and try to get as much money as you can for that. Like, I think our range was 1.25 to 2.5%. So it's about a 2, it's really difficult to get that much premium, but if that's a big thing, to get as much premium as you can. Avoid earnings. And one thing that wasn't in the test was we did it for a large pension fund, was avoiding conferences. So we work with Wall Street Horizon, and they give us the conferences information. So that was a good thing to avoid, was conferences. So that's kind of a side note. And exiting, it just says to hold it all the way to expiration. And that was the best performing covered call is following those rules. And, like I said, millions of tests. And that's still a big blog that a lot of people go to on our site, blog.orets.com. You can go read all about that.
Check it out, listeners. I know a lot of you like covered calls. If you're not checking out Matt's data first to arm yourself, you're doing it wrong. Speaking of Matt's data, in May on the show, Matt, we discussed, sounds like you saw a study on a forum like Elite Trader about overvalued out-of-the-money calls and puts and finding ones that are particularly overvalued. This gets back to, I think this year, you gained a new appreciation once again for the wings out there. So what were your thoughts on this, and what did your study find as you were analyzing overvalued wings, sir, back on the show in May?
Yeah, so and you knew it, and we both knew it. Never be short units, but we were finding these, in these we have these scanners. We were finding these way out of the money calls and puts, and they work until they don't. And so, I end up making money. Just I like to do it. The Cirilli Institute, they really help the advisors out. And one of the big things that they say is trade in your own account before you start telling other people what to do. Is the best way to do it for advisors, of which I am one. So I said, I'll try this out. So, I think I was still up, but I just got pummeled on one or two of them. And I go, I don't need the stress. But yeah, you can find these way out of the money, but you should try to find some type of either a calendar, or once you find them, or have some protection. So that was the lesson I learned from that, Mark.
I think in the early days, you were even venturing into some of the crazy ones like AMC, and those were ripping, it was so hard to do anything on those because they were ripping so many handles and getting into the hundreds, if not 1,000% volatility so quickly. So yeah, everything just went haywire. And then into the show in the middle of the year, June, we revisited one of our favorite positions. We frequently called it on the show, the holy grail of options positions for financial advisors. This is the collar. This year, 2021 was a bit of a challenging one, I would say, for the collar, because there's an optimal setup for the collar, and it really just wasn't there for a lot of the year. Usually you want puts that are fairly cheap so you could buy decently low cost protection, and you want calls that are fairly bid. And that obviously sets up a situation where you could put collars on, get nice tight protection without a lot of outlay, and maybe if you do it right, maybe even a credit if things are crazy bid. We did not really see that set up. In fact, for most of the major indices, we saw markedly the opposite. The calls, no one wanted to touch them, and the puts were bid to high heaven. So it made it very challenging if you wanted to go out and buy, let's say, your monthly puts in SPY. The premium you're paying upwards of 30% premium over the at-the-money vol level for those puts. That's hard to offset with any type of collar. The calls you were selling were so nominal from a vol perspective, it almost wasn't even worth doing. You're giving up all your upside for a few cents, a few vol points. It really didn't make a heck of a lot of sense. So you had to really play with the collars. You had to push the put out quite a bit. You probably had to do some sort of put spread against it. So you had to have a second leg to sell against it. And then you also had to do the nearer dated calls against it. And hopefully over time, the nearer dated calls would add up to offsetting a significant amount of that put. Of course, by the time you got to that level, the market had moved away from your put strike, and your put was pretty much valueless anyway. So it was a challenging year for the collar. I know, Matt, when we talked about these in June, you were kind of lukewarm on collars, particularly because the call just wasn't worth it out there. Is that still your viewpoint as you wind down the year, sir?
It is. And, you bring up a good point. You don't just sell calls because they're there. You need to get enough money for them to even make it make sense, because that's often where your profit, you're giving away a lot of profit there. So, and I think it's really apparent when you start looking at like the skew of a crypto. Like if you look at BITO, it's incredible. You could really, that's what I've been doing is the collar, because you can. The calls are even higher than the puts, and you it looks so great. I wish the markets were like that. But that's why, you have to find, for just regular stocks, there are some stocks out there that trade like that. But you also have to watch out for those stocks. So yeah, the collar is tough. We've been testing some interesting butterflies, even imbalanced butterflies, like buying one, selling two near the money. Selling three near the money and then buying two. So you're unit neutral. You're getting a fair amount of premium, and you can make some money on the way up. So it's the collar is kind of tough. You can do a butterfly on the collar side, especially the ones that I've talked about with different ratios that help you get some of that upside without giving away too much. But that's what I've been finding, Mark.
And then in July, we revisited another popular strategy, which is ratio put spreads as a hedging tool. Not the traditional put spread, buy one, sell one. You're talking ratios where you're typically selling one nearer the money and then buying more, usually two, farther out of the money. Obviously, if you think about that, listeners, in the near term, if you're short one, you don't want a little bit of a sell-off. You really need a big sell-off to blow through your long strike and have that second put start kicking in. And an intriguing strategy. It's one I know some people utilize. I know Talib and others utilize this out there. Talks a big game about black swans, but the way he hedges it is actually through these types of ratio put spreads. He doesn't just load up on puts like everyone thinks. But interesting stuff. Mr. Matt, what are your thoughts on ratio put spreads? I think we also on that show very briefly discussed 1x2 call spreads in VIX as well, kind of the flip side, the flipping of that script in the vol product. So any thoughts you have on those as well, have at it, sir.
Yeah, definitely. I mean, my favorite thing to do is just test these on their own. So what is the best way to sell a put? What is the best way to buy a put? And then you can combine those. But what I've found is actually if you're selling the shorter dated out of the money, you can still get a fair amount of premium in those. And, especially if, your market signals aren't too haywire. I mean, you could kind of look at some levels of VIX and determine not to do it on very high levels is kind of what we found is when the VIX gets really high to stay away from the selling of the puts. And then the buying of the puts, I've talked about this many times, is you want to have, I think, a portfolio of those. Like I like even the long dated puts, like 500 days, way out of the money. Those should be in. A lot of people have puts at other tenors and other deltas, but what I've been hearing from people is I've finally convinced them that should be part of their overall portfolio of their hedging and their puts is that longer term. Now it's a little bit difficult to do that longer term one now, especially when the volatilities come up, and we have back tested pretty specific ways to get out and monetize these puts. So, for example, even now I'm just starting to get back into those after having monetized them over the last couple months, Mark.
Speaking of monetizing your puts, that was our topic for our most recent Educational Options 101 segment. Back on our last episode, we talked about how to pay for puts. We revisited a lot of different ways you can do that. The collar we just talked about, the put spread, there's a lot of different ways you can go about paying for puts out there. But yeah, as you just mentioned, Matt, you kind of threw an interesting wrinkle into that discussion, which are your, I think you called them, what was your devious your devious puts, as you called them on our last show. You kind of just broke it down. You're very, very far out of the money, pretty long-term puts. How's that been working out for you? I know a lot of our listeners are intrigued by that strategy, sir.
Yeah, so this is a good point because I'm kind of in the middle of it to the end. So you have to have some type of a monetization strategy for these puts. So again, we're talking about these ones that you'll come in when the ball just pops, and you're nowhere near. There's no gamma in these things. It's just all vega, and the vega really pops, and so you could really get a decent amount. But you want to have them for a while, and when we were on the floor, we developed these kind of systems for monetization, which is and again, this is all subjective, but if you have some type of a hard and fast rule, I found that it helps. So we would monetize 20% right away. So right when we had some profit in something and we had a chance, we would monetize about 20% of that, and then we'd monetize 40% when we had gotten to a level that we were looking at, like that we wanted to make. And then you do maybe another 20% not too far away from that 40%, see if you can get a little bit more, and then you just keep the 20% on almost at all times, so just in case something happens. So I'm in that kind of period right now where I've got about 20 or 30% of the puts left. So I'm just starting to get a little nervous because I monetized most of them, but I'm anxious to get back in. It looks like vol is coming back down. So so what you want to have is you want to have a lot of these puts on. So when the market goes in your favor, then you can start getting out of them. And then you also want to have these short puts that will help pay for everything now. So it's kind of crazy right now. It's great because I don't have the bleed. I usually, every day is a bleeding day a little bit, but now, just based on where my puts are, I don't have that. So, but now I'm getting a little nervous. I'd like to, I always like to have puts for the proverbial rainy day. So that's how I go about those out of the money puts. They're great to have on. They help you sleep better. You could do some other things with your portfolio, get a little bit more aggressive. I dabble in the UVXY and SVXY, VXX. But I do agree that it's nice to have those way out of the money. Those actually help. I think I have 130 strike VIX calls. So on that 1x2. So that's kind of, I know it's a long-winded hedging strategy, but that's how I like to do it, Mark.
The 130 strike.
Yeah.
I like that. I think I saw Scott Nations, one of our other frequent guests, was just tweeting about someone bought the 100, 150 vertical in VIX. Maybe that was you, Mr. Man, out there. But yeah, you're interesting stuff. I think you're right. That's the question a lot of people have with that. So those kind of garbage puts is, what do you do with them, right? When do you start taking them off? So I think it makes sense to have some sort of monetization strategy ahead of time. Otherwise, you're sitting on these things and you're right. You're getting a little bit of bleed every day, and you're kind of waiting for that big, crazy downturn. And if that doesn't happen, what do you do to incrementally take these things off in a sensible fashion? So that's just a quick overview of some of the educational topics we hit on the show this year. Hopefully you enjoyed it. We also hit on a lot of fun topics that were top of mind for us this year. It's time to get the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, listeners, you've been listening to the show all year. Kind of the top story for a lot of people coming into the year and indeed to end the year is this notion that this options party just keeps rolling on. We hit a record at the time level of 7.52 billion contracts at the end of last year. It seemed like an anomaly. It seemed like the entire world of 2020 was an anomaly. Everyone was stuck at home, and all these situations that probably wouldn't be replicated in 2021 existed. So it seemed like the inner cynic in me, the skeptic, said, we probably won't hit those numbers again. And if we do, maybe we don't want the societal impacts that will be required to get there. And then, of course, 2021 came along, and as you said, January was the most insane part of the year. 2021 said, hey, hold my beer. I can show this kid what's going on. And the numbers have been just ridiculous, I think is a technical term. In January, we hit 843 million contracts. That was just in January. That was a record at the time. That was the most active month in the history of options. We since set new records almost every month throughout the entirety of the year. By March alone, already by March, we were up to 904 million contracts just in that month. So that was a new record alone. So it seemed like we were on pace to beat 2020. And sure enough, we were. We beat that 7.5 billion by about mid-October. I think we ended October a little bit north of 8 billion, about 8.1 billion in total contracts traded for the year. Of course, we're putting up about almost a billion contracts a month. In November, it was 944 million. So 8.1. So you're talking about 9 billion contracts at the end of November. We don't have the numbers for December, but it's a pretty active month so far. So you got to figure it's somewhere in that ballpark. So we're threatening 10 billion contracts to end the year. We won't get there probably, but we are threatening that, which just saying that out loud is insane. 7.5 billion was insane. 10 billion or even close to that is complete insanity. So we asked you guys, that's our question of the year to end the week right now. Get on out to add options if you haven't played ball yet. We said 2020 was a record year for options with over 7.5 billion contracts changing hands. 2021 is threatening a record 10 billion contracts. So our question to end the year, can 2022 possibly top this record? Options volume level. Gave you three choices again. Yes, we're in store for another record year. No, the party is over, or you're too busy buying GameStop calls to care. Mr. Matt, what are your thoughts on just this insane options volume numbers we've been seeing pretty much month after month? I mean, 10 billion we're threatening. Just say that out loud. It's insane. And then B, what are your thoughts on our question of the week here? Do you think we can threaten that again or perhaps even exceed it next year?
So I've mentioned this, but if you look at just the money supply, and I think that has to be one of the indicators for the amount of options that are out there. So as we print, all the financial instruments kind of blow up, and options is no exception to that. So I think that you could pat yourself on the back, but I think a lot of it is driven by these Fed policies that are just off the charts. Literally, the charts that we were looking at even a year ago, the money supply is off the chart. So I think that has a lot to do with it. Obviously, this volatility has a lot to do with it. That's what's 2017 was kind of our last breath of normalcy of option volume until it blew up. So obviously, 2017 was a quiet year. So 2018, really reignited the volume. So I think it's a combination of the money supply and a combination of volatility. And if I were a betting man, and I am, I think it's going to continue. I mean, I think you'll see more printing and you'll see more volatility. So I think we're going to see a lot more of the same. And obviously, there are other smaller things like more players, more people learning, more retail, better technology, but I think that the two bigger ones are just the volatility, but really the money supply and printing is really leading a lot to this these insane levels that you just almost never dreamed of, especially when I started, Mark.
Speaking of insane levels, that's pretty much what we saw for crypto. I think you can say, and there's many things that happened in 2021, the meme stock revolution. I think this is also the year where crypto really went mainstream in a big way. It seems crazy to say now, but a year ago, late December, Bitcoin was at about 29,000, 28, hadn't broken 30K yet. So, of course, the new year kicked off. That's why I said January was the apex of insanity. We broke 30K almost instantly, like the second trading day of the year in January. Then we promptly broke 40K not too long after that. Got up there on January 8th. A few days after all the madness down in D.C. So then we broke 50K not too long after that. Then, of course, we got up to north of 60K. We threatened 70K, then came back down the other way, broke 60 and then 50 and then 40 again. So interesting stuff. We hit 1 trillion in market cap, something people maybe thought wasn't possible, or if it was, wouldn't happen farther down the road. That happened this year before surrendering it again. We've mentioned, of course, a lot of the other cryptos really started penetrating into the mainstream more. ETH started becoming much more popular with a lot of you out there. Of course, a lot of you got into some of the sillier ones as well, like your Doges and your Shibas. I'm looking at you, Unlimited, there in the chat. I know you like yourself a little bit of Shiba. So there's been kind of a crypto for everybody out there these days. We had, of course, big mainstream platforms really launching more products. CME launching ETH futures, micro Bitcoin futures, and micro ETH futures, all in the span of this calendar year. So they've really gone whole hog on all things crypto. And then, of course, the watershed event of them all, I mean, outside of the price action in Bitcoin, was really, as Matt alluded to, this launch of the BITO. It really just changed the game for a lot of people here in the U.S., especially for our audience. You've all been asking since day one, where can I get some Bitcoin options? And the answer was usually not many places. So BITO changed that, and in a just dramatic fashion. As Matt mentioned, it was very attractive for callers out there when it first listed. And that brought Bitcoin options where you wanted them, into your securities account. So that's been a game changer for a lot of you out there. Matt, what are your thoughts on this insane year from a crypto perspective? And do you agree with that synopsis there, that this was the year that crypto became mainstream? So, which, by the way, think of this too. 4 years ago this week that CME launched their Bitcoin futures. Can you believe it's been 4 years?
And I think I was on the crypto rundown back then too. Mark, you know me. I have a weird look at crypto. I've had an ambivalent relationship with it for a long time. I'm really wary. I'm getting, and the more uptake, the warier I get. Meaning, there's no way that this Federal Reserve corporatocracy world that we live in is going to allow something unless they want it to happen. And so, I think the strategy for them is to almost look like they don't want it, but almost look like they want it. Meaning, so as the adoption starts, and I mean, in MicroStrategy, there's a pretty cool YouTube video with the CEO of MicroStrategy out there. It's good. It's a good watch. But as more and more of these companies adopt it, I just get a little bit nervous because I think what they're really trying to do is shoot for a central bank digital currency. I think that's the kind of the long-term game, and that's not a very good thing for us freedom-loving people. So, I have an ambivalent relationship with crypto. I think, they could shut down crypto pretty quickly. People say they can't. I think they can. The fact that they're letting it go. I think it's the fact that they're letting it go. It's going to go higher and higher. But I also think that it's the end game isn't a pretty thing, because eventually the central bank digital currencies will swamp these cryptocurrencies. So I know it's kind of a crazy outlook that I have, but mark my words and let's see what happens in I think 8 years is kind of my horizon on that call.
8 years. Interesting. We have a lot of other trends and top stories that were big issues, top of mind for us here on the show in 2021, but we got to get some of you as well before we wrap up. So let's get on out to the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, really quickly, we had a lot of great questions from you guys over the course of the past year, a lot of great comments. We also asked you guys some interesting questions, like back in January, when all this meme stock madness was popping off. We asked you, how are you guys trading this meme stock frenzy in game and others? They should call it the short squeeze frenzy. The term meme stock hadn't really been coined yet. We gave you 4 choices: buying calls or spreads or flies, buying puts or spreads or flies, selling puts or spreads or flies, and then other. And nearly 60% of you said you were buying calls /spreads/flies. I got a feeling most of that was the call, the call side alone. So yeah, not surprising you folks were loading up on calls there. In April, we asked you, which level are we going to hit first? A VIX of 14, SPX of 4,300, a Bitcoin of 70, or WTI of 70 out there. It was actually very evenly split, almost 25% for each. So our audience, aka you folks, were very evenly split back in April. And I have to look out to see. I think it was 4,300 that came first. I know we flirted with 1501 in VIX closing. I'll have to see on back. That was back in October. I don't think we might have printed there earlier in the day, but that was obviously after we hit 4,300 in the S&P. So I think it was S&P 4,300, but I will have to check. We also asked you guys right now, if you could buy a 10% out of the money call. This was back in May. If you could buy a 10% out of the money call in any crypto, which would it be? Bitcoin, ETH, Doge, or other? And 54.8% of you said ETH. I'll have to go pull up an ETH chart really quickly, but I got a feeling that was a pretty good call from where ETH was back in May. Let's see if I can get all the way back to May. Yeah, ETH back in May was in the 2000s. So yeah, you did good on that one. It depends when you bought it. May 11th, it was 41.79. Then, of course, we saw the sell-off. So if you bought it in early May, a little bit more challenging because it was already at 4,000. If you bought it in late May, back to 2,100, you're looking pretty good right now. So I guess it depends where you were in May. We also had questions about collars and everything, but I want to get out to questions about annuities, all these other things. Let's get out to the live I know you folks have been asking us some questions while you've been going on, like Mr. Luigi, my boy Luigi. He's got a question for you, Mr. Matt. He says, I mentioned a strategy in UVXY the other day, and I wanted to ask Matt what he thought. I place a call ratio, so buy 2, selling 1. So he's doing kind of the inverse of the typical ratio in VIX, which is sell 1, buy 2. He says, depending on the vol, I let it run up, then I add a 5 or 10 lot of puts for a dime to 15 cents as soon as I see the candles turn to the downside. I've had some success, but am I running the gauntlet? Is it a ratio with the credit? It is a ratio with a credit or small debt. I remember you mentioned this now. I think it was on Vol Views 2 weeks ago now. Luigi. Mr. Matt, I remember I think at the time lukewarm on this because it was the inverse of what we traditionally see. But Mr. Matt, what are your thoughts on going out to VIX and flipping the script, buying 2 and then selling 1 and then letting it run up? And then if it does start to turn, not so much taking it off, but adding some puts, cheap puts, a dime to 15 cent puts against it, sir.
So I think he's talking about UVXY and buying 2, selling 1.
Yes, UVXY. I'm sorry.
Yeah. So, I mean, UVXY is the one that goes down and down and down and down and down. And sometimes it pops up. So this sounds like sounds like a long UVXY. I don't, I don't play it that way. I like the, my testing shows that the UVXY, when the market tends to calm down, VIX under 15 range is when it performs best, like for these put spreads. So I like the put spreads, selling call spreads, and UVXY. It's been one of my better forming symbols. I haven't done very well on SVXY, and I saw this video the other day on someone saying don't trade calls in SVXY, so I have to look that up. But UVXY has been pretty good. So that doesn't sound like a very strategy that I would like to do. I mean, I know you could get a pop once in a while, but what I like to get in there when things are quiet and start just playing those put spreads or selling call spreads, Mark.
Well, I tried for you, Luigi. That sounds like Matt's not a huge fan of that one. It's hard to go the long units to the upside in UVXY, no matter what else you're doing against it, and make that work consistently over time. That's a challenge. I mean, we've talked about many times that if you do get a pop in UVXY, to make that 2x1 pay off, it's so short-lived. You got to really be on it to make that worth your while. And then, of course, where you get your puts is another big question. If you're going to have long units, to me, I'd much rather have them to the downside. But hey, you've discovered this strategy. If it's working for you, hey, we're not going to dissuade you. I'm kind of lukewarm on it. Sounds like Matt is. I can't remember what our other panelists, I do believe most of them were kind of lukewarm on it. It's not how that product was designed, but intriguing stuff. That's why we like you folks. You're always throwing us curveballs. Unfortunately, that's going to be our last curveball for 2021. We have a lot more in store for you for 2022. Don't you worry, listeners. Now, Mr. Matt, if folks are intrigued, maybe they want to hit you up with a question or check out, like you said, your blog about covered calls or any of the other cool stuff cooking over there in the land of ORATs, where should they go? What should they do, sir?
Yeah, hit me up. We have a great team of developers, and we're coming out with new stuff. We need testers. So Matt at orats.com if you want to test our option scanner. We have a new stock scanner for the first weeks of 2022. So we're incredibly excited. We have a ton of stuff coming out. If you want to test some of it, just to reach out to me. We'll put you on our alpha testing list. All you have to do is just tell us what you think about it and some ideas. So it's going to be a fun 2022, Mark. I'm really looking forward to it.
We got a whole chat full of alpha test. I can't imagine better people to be your alpha testers here, Matt, than these folks here. So everybody in the listening, you guys should hit up Matt over there. Sign up for that alpha testing. He's got great stuff. If he's willing to let you test it, you should take advantage of that. And no, Mr. Luigi, I'm not offended. You should always look for second opinions. It's like a doctor. Always get a second opinion for your trading strategies. Always get a second opinion before you finally pull the trigger. And of course, you know where to go to pull the trigger on some interesting education in the options realm. That is, of course, optionseducation.org. They have that great section, of course, for financial advisors and everything else they have cooking over there to keep you informed about options heading into the new year. Of course, stay tuned to the rest of the network. Listeners will have a lot of great stuff in store for you to kind of carve up this crazy mad year of 2021 in a lot of different ways coming up on, of course, Option Block and TWIFO and Vol Views. Of course, all the educational stuff coming up tomorrow. Coming up later today, if you got more questions, I know you do, keep your powder dry. We got Simon coming up now in the Pro Q&A hot seat in less than an hour. So we'll rejigger some stuff here, get Simon on. So we'll be back in the live in a little less than an hour now, listeners. So if you haven't sent your questions in yet for Simon, get them in. It's going to be a fun one. And then, of course, we'll be back again next month, indeed next year, with another episode of The Advisor's Option. We'll see you then.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the CBOE over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.